So I think that we're going to see a very industry-specific recession, mostly with respect to real estate, but I also don't think it's a recession that everybody's thinking. I actually think to some extent we've almost seen the worst. So I was talking to a car dealer today, or yesterday. What am I talking about today? Yesterday. And he's a guy that I went to high school with and grade school with. He's actually a year younger than me. So we kind of grew up in the same neighborhood, and he works at one of the luxury car dealerships in town, and he's been there for fucking ever. And he had a really interesting kind of take on what's going on in the economy, and it was really interesting to me because if anybody would see a shift in what's happening in the economy, it would more than likely be in the luxury car space, right? I feel
in a real deep recession, the purchasing of those types of vehicles would for sure plummet.
Exactly.
2008, 2009. I don't know the statistic off the top of my head, but I guarantee you.
I would imagine, right?
That
he said nothing slowed down.
Interesting.
Nothing. And if anything, he said it's like picked up, even now, which is really odd, even given interest rates and everything. So it's really interesting to hear that from him in that space because, I agree that if something was going to be happening or is happening in the economy, you'd see it from him. And I'm not saying it won't eventually happen, and maybe we're primed for something to happen, but as of right now, nothing's changing. If anything, he said he's busier than ever right now.
Do you think that's Canada specific, or do you think that's Canada US?
I don't know.
Yeah.
This is specifically our area, our hyper location. I don't know anything else about the rest of Canada, the rest of the dealers in Canada, the US. I don't know anything else. All I know is that was what he told me, and he doesn't bullshit. He's not like a bullshitter. I've known him forever. I've spoken to him when he was working there during like the 2008 and all that bullshit, and then they were like deathly slow.
Yeah.
So there is a contrast where he remembers when they were slow.
Yeah.
He wasn't in the position that he's in now. That was, quite a while ago, but he does remember there was a difference. So really interesting.
Do you think that, I remember probably 5 months ago, you and I were sitting here doing a podcast, and we were talking about how we're entering into a recession, and that people are kind of blind because this is still, we're in the news, like no one was talking. This might have even been more than 5 months ago. Still in the news, no one was talking about it. Like it was still, everything was going good or whatever. It's maybe March, April of this year, and we were saying how we are entering into a recession, but it's going to be a different recession than ever before because it's going to be a recession that only impacts certain demographics.
Okay, so let me explain something else to you. So, who was I talking to? Oh man, who was it? I don't remember if it was the same guy about the cars. But I was talking to somebody. Who was it? Doesn't matter. I was talking to somebody that has a client that installs pools. And he's starting to get a lot of calls about cancellations. Now, I have a theory, okay? When you buy a car, you're not typically putting down a bunch of money, okay? And you're typically not using your equity in your home to buy the car,
right?
Okay? You're financing it,
and
you're leasing it.
This is a luxury dealership, right? This is not like
it's a fucking BMW dealer.
Okay, yeah.
So, and they have Mercedes. If you're local to the area, there's only one. You're gonna know who it is. Yeah. So,
so pool guy,
and who was I talking to? It was my buddy, the doctor. That's who it was. Remember when with my foot? Because I think I have a broken foot. So when I went in there, it was my doctor, my buddy Ryan, who told me he has a client who installs pools, and they were talking, and he's saying he's getting a lot of cancellation requests for people that wanted to install pools. My theory is that we had low rates forever, right? and people were just pulling equity out of their houses to do all kinds of shit. Well, those days are gone now, right? You're not getting the same amount of equity. Banks are tightening up. Rates are much higher.
Because they might have been doing a HELOC to get a pool.
Well, that's what was happening. And that's why you're seeing all those renovations going on, like all that kind of shit, right? So at the end of the day, I think that what's going to be happening in the recession is also going to be very industry specific. It's not going to be a recession across the board. I think it's going to be an industry specific recession, which if you actually look at recessions in general in history, they are typically very industry specific. And that's typically how recessions kind of work, right? Where, certain things in previous recessions took down very large industries, which then did bring down the rest of the market, but not the entire market as a whole. There are still industries that do fairly well during even recessions, right? So I think that we're going to see a very industry-specific recession, mostly with respect to real estate. But I also don't think it's a recession that everybody's thinking. I actually think to some extent we've almost seen the worst. And the worst was driven by a rate shock. And that's it. I don't think that, look at the Feds in the U.S. just bumped the rate again, the overnight rate by a half a point, 0.5%. Nobody really even fucking balked at it. It wasn't like this big crazy thing again.
Yeah.
Because the percentage of that increase overall is kind of... Yeah, it affects affordability, but it doesn't affect as much from going from 2% to 5 or 6%. Those days are done.
Yeah.
Right. So now the rate will just probably fluctuate a little bit here and there, but it's not. I don't think we're going to see the rates that people were talking about, the double-digit rates, and I don't think that we're going to end up seeing the recession that everybody's calling for, where everything's going to be on a fucking fire sale. Yeah. It's not going to happen.
I think that there's going to be, so there was statistics that came out already just this week for November stats for the U.S. Now, whether or not this is going to be have the Canadian parallels is a different story. But officially in November, the year-over-year average housing price in all of the U.S. is down for the first time in many, many years, right? It's down 3% on average across all of United States real estate.
Only 3.
Yeah, only 3%.
Okay.
And then in addition to that, there was in November, there is now the highest amount of delinquencies and late payments on mortgages for the highest amount ever since 0809. That's another statistic.
It's not really saying much, though, to be honest.
More specifically, there's I forget the exact number.
It's saying something, but it's not saying. Given context,
right?
Given the context of that, it's been really good,
right?
Really, really good for the last decade. Yeah. So okay,
and then the types of mortgages that are being the most impacted. This is kind of going full circle to what you were just saying in terms of affecting different demographics and industries. Is what do they call it down in the? There's a name for the type of loan in the States. Not an HOA. It's a specific type of loan for people that are doing 5, 3, or 0% down. FHA.
Oh, okay. Yeah.
Have you?
What's it stand for?
Federal Housing Administration.
Yeah. Okay.
FHA.
It's loan. It's our CMHC.
Yeah, exactly. Yeah. And so. Specifically, what they have in the FHA loans were the ones that were essentially screwing people over in the 0809 because the FHA loans were 0% down, right? And they had essentially stated income back in 0809 and not actual didn't check your actual income. And so what's happening right now is that the FHA loan, they kind of changed it a little bit since then, whereas the minimum down payment that you can do is 3.5%, right? So that's what they have. I forget the exact statistic, but it's something 80 to 90% of the delinquencies and of people that are late on their payments or underwater on their mortgages are specifically in these FHA loans. And who are the people that are getting these loans? Typically, lower incomes, typically people that don't have, they have lower credit scores, right? There's a specific demographic.
They don't have enough into the property for them to stick with it.
Exactly. Yeah. And right now, in November, 2/3 of the FHA loans in the U.S. are underwater on their mortgage. 2/3.
Really?
Yeah.
Wow.
Which is very interesting because, let's say, for example, let's say one of the properties that you own, let's say that the housing prices went down by 25-30%. You're going to keep renting it out.
Yeah.
You're going to keep paying your mortgage. It's not going to affect you. It's not going to affect a lot of people, even for example, someone just on their principal, even think of your house, right? Let's say, for example, your house actually decreases in value past the point of the balance of your mortgage. You'll still be fine, right? You'll still be making those payments.
Yeah.
Where it's the people that are, let's say, for example, just like scraping by paycheck to paycheck that are now underwater on their mortgage. They can't make the payments because a lot of those mortgages as well are adjustable rate mortgages. So what happens is the rate increases so quickly, they can no longer afford it. They start getting late, and now they're already underwater on the mortgage, and then they're going to be forced to sell the property at a loss, right?
Or another interesting thing. This is what, when I was talking to my buddy, the car dealer guy again, he doesn't own any property. He doesn't own anything. He's big into the stock market. He loves the stock market. Okay. You know, different strokes for different folks, I guess. Yep. But he said something really interesting to me. And he said, when the people, what did I say? I kind of wrote it down, but he said, I've never heard a better quote I've never heard a better quote that's more applicable now than ever. And he said something to the effect of, banks will change the rules when the guy that holds the gold comes calling. And I don't know if that's like a popular quote or whatever.
I've never heard that before.
But
say it again.
And I might be butchering the actual quote that he mentioned, but it's very applicable to right now. Banks will change the rules when the guy that holds the gold comes calling. Well, the banks hold the gold, right? It's their money. So in order for them to continue to make money, they're not going to make money getting those homes back. The way that they're going to continue to make money is to change the rules on the money that they lent out.
Yeah.
Get what I mean? So that those people that they lent the money to keep paying. That's what's going to happen. We're not going to see this mass exodus. Will we see some exodus? Maybe. But we're not going to see a mass exodus. We're not going to see it. Because they'll change the fucking rules. They will. They'll increase the amortization. They'll lower your ability to get, or lower your prepayment penalties when they force the rates to come down, or when they institute a higher amortization to lower your payments. They'll allow you to just roll your current mortgage in. They're not going to fucking. They don't want that. Banks do not. They are not landlords, and they lose money in the event that they have to force a sale. Right. They don't want to do that. And then he also mentioned, really, really smart kid. He also mentioned money's too liquid and agile right now for bear markets to last too long. So he's like, and it's so accurate, because think about the last recessions, all of the last recessions that we've gone through. Money was not nearly as liquid as it is now. You can go on the internet and fucking press a button. You can go on the internet and buy a home with a button. Okay? There's so many things that allow you to be liquid these days that recessions simply do not last that long. And I think that that's another thing that people are not factoring into the mix, is the agility of markets these days and money and capital. It's way too liquid.
I couldn't agree more.
Right?
That's such a good way of putting it, too.
It really is. And his other quote about, the guy holding the money, or the guy that controls the money, and you just change the rules.
Exactly, because you've even said before, in terms of like the bank at the end of the day needs to make money as like a business as well.
Yeah.
And so if, for example, the applications for mortgages have been declining over the past couple of months, they're going to find a new way in order to try to get applications for mortgages up again.
I already see it in the U.S. It's already happening in the U.S. The rates go up, and all of a sudden, like, the bank rates are still down.
Yeah.
Or they come like
or they just get creative.
Yeah. Or they're getting creative. They're closing their spread, like whatever you call it, whatever you want. They're allowing longer periods of interest only. They just change the rules. That's all they do. They just change the rules in times like this. Even right now, they're lowering their prepayment penalties. So in the event in a year or two when rates come down, you can roll into your other. Into another mortgage. They're already doing it. I'm already being quoted on loans right now that allow you to have a very low prepayment penalty, because the banks know that this will not last that long. High interest rates, they're already forecasting them to come back down, or at least to not to what they were, but to land somewhere in between, around a 5%, maybe even like a 4.5%. They're already pricing in their underwriting on these properties based off that notion that in a year or two, I'm going to want to come back and buy out my interest rate for a lower interest rate that is going to be instituted at that or put in place at that point in time. They already know.
Any more theories, either from you or from your buddy from the dealership, on like why this is happening in terms of like demand for luxury vehicles still being at an all-time high?
There's a lot of money in the world right now. You got to think. There was a graph. I'll send you the graph, Connor. I found this graph from. It was like I can't remember where it was from. It was like from Ford's or whatever. There's an absolute ridiculous amount of capital in the world right now. The reason why is because all of those subsidies that went out during the pandemic, all of them went to lower income, medium to lower income households or citizens or whatever, the population in general. And because those demographics have poor money management skills, they went out and spent it all. Okay. And all of that capital ended up in the hands of
business owners, shareholders, the top 1%, the top 10%, you name it, doesn't matter. And what did they do? They didn't go out and spend it all. They are holding it. They're holding it because of their anticipation of what we are talking about during this podcast. In anticipation of, not a fire sale, but their ability to maximize their capital, right? Putting it in investments that, are on sale, or, they're waiting for this mass exodus of, homeowners and stuff like that, which again, we're arguing won't happen. But what we're starting to see now is they're realizing this may not happen, and the longer the longer that they wait for it to happen, the longer that capital is just burning a hole in their wallet. So that's my theory. He doesn't have a theory. He's just telling me what he's noticed in that market. That's my theory. There's just so much money. You can see it on the graph. It's fucking substantial. Like, it spikes the amount of capital, and that's the only reason why that would spike is because of the sheer volume of capital that the government's introduced during like the last couple of years. That's it. There's no other explanation for it.